Why do banks keep losing our money? Bank accounts are supposed to be a safe place to store our money in, yet all the headlines in recent weeks are about banks failing after becoming unable to meet withdrawal requests. Their customers can't get all their money out. So, what gives? What is happening to our money that we thought was safe? Banking, as we think of it today, evolved in the 14th century in Renaissance Italy. Banks serve two fundamental purposes. The first is a safe place for depositors to store their money, and the second purpose is lending out money to customers who want loans. You wouldn't want to keep all of your savings and wealth just hidden under a mattress. Someone could simply break into your house and take it all. So banks evolved as a safe place for people to securely deposit their money without the fear of it getting stolen. It just so happens that having a large pile of cash on deposit is perfect if you are a financier making loans. Instead of just lending your own money, you can also lend out other people's money and make much more profit with more money on loan. To sweeten the deal for the depositor, not only do you secure their money for them, but you also pay them a portion of the loan proceeds since their deposits were lent out. Seems like a win-win all around. This combination of interests is the core of our modern banking system, securing depositors' cash and lending that cash out to others for a profit. So what makes banks so vulnerable then? A maturity mismatch occurs when short-term liabilities exceed short-term assets. Banks make loans with long durations. Think a mortgage or business loan, where the bank doesn't expect these funds back right away, but rather over many years. Most mortgages, for example, are 30-year loans. But these banks have inherent short-term liability exposure. Customers can and will withdraw their money at any time. If a few people withdraw their money from a bank, that's no big deal. The bank should have enough cash laying around to meet those withdrawals. But if too many people want to withdraw their money at the same time, and the bank doesn't have enough cash on hand due to it all being loaned out, the bank has a big problem, since the bank can't just demand mortgage holders return their mortgage on the spot. Even the fear of insolvency can cause a bank run, where depositors rush to get their money out of a bank they perceive to be unsafe, which can cause an otherwise healthy bank to quickly become unable to meet withdrawal demands and collapse. This simple concept of a maturity mismatch is a large part of what caused the 2007 subprime mortgage crisis and what directly led to the downfall of Silicon Valley Bank a week ago. It is an inherent risk of fractional reserve banking. So, what can you do as a depositor to ensure your money is as safe as possible? Well, if you live in the US, all deposits up to $250,000 per account holder are insured by the FDIC, meaning that even if your bank were to go bankrupt tomorrow, all money within this limit is safe and guaranteed by the federal government. Anything over that $250,000 limit is not insured within the same bank, but would be insured at a different bank. So if you had, say, $500,000, spreading $250,000 each across two separate banks would ensure your money is safe. Lastly, if you have a lot of money on hand and want to be as safe as possible, the unfortunate truth is that the safest banks to store your money with are the biggest banks. The larger a bank is, and the more customer deposits it has, the less likely a bank run is to occur just out of the sheer size of the deposit base. But for most people, any bank with FDIC insurance will be just fine. Thanks for watching.